We're joined by Mr. Mueller, and we'll take his view as to how he's seeing the entire tariff thing being played out.
Actually, more important than that, Mahima, I would love to know from Christian as what's his worldview currently, considering that we are past 6 months and another 6 months to go. Christian, great having you. Thanks for taking the time out and being with us. How do you see the investing landscape from your lens right now, considering that there is, for lack of a better word, a fair degree of uncertainty still there, even if you account that the tariff issue is now well and truly known?
Yeah, thanks for having me and good afternoon. I think you're absolutely right. It's quite unusual if you consider that we're still having so much uncertainty on tariffs, still bad headlines, but markets are shrugging this off. And I think it comes down a lot to, we've been calling it the Goldilocks scenario that investors have shifted towards. And there's really like 3 drivers. The first one is that at the Liberation Day, the trade policy uncertainty was so high and the concerns were so high. And since then, the momentum on trade policy uncertainty has actually been down. So things have gotten less bad. You've had a deal in Europe, you've had a deal in China, you've had generally like occasional escalations, but eventually there was always a deal. So the market has moved on a bit from trading the uncertainty around trade policy and possibly focusing more on the impacts. A bit what you said earlier, they look at specific winners and losers, but not necessarily the impacts on the market level. And the other 2 things that have gotten us to the Goldilocks regime is the fact that the data, like the hard data, like labor markets, earnings, all of those things have been reasonably good, especially in the US. So unemployment rates are low, profits are good. The earnings season in the second quarter has been good, obviously led by tech. So that has actually made the market relax on equities. And the last thing, which is really important, that has gotten us to this friendly backdrop, at least globally, is the fact that inflation and inflation expectations and monetary policy expectations have shifted more dovish at the same time. So putting all of that together, I think you are in a reasonably friendly Goldilocks backdrop. The key fear we have is that in the second half that will be challenged.
Christian, if one considers the earnings and the commentary that have come in from the tech biggies, and overnight I think we've heard from 2 of the largest companies, including Meta, right, that their spending power on AI seems to be on. And does that mean that for the longest time, as people have been saying that let's look at the market beyond the top 7 tech companies, but that may not be the case because almost every quarter they come out, or every half year they come out with an earnings report as well as commentary, which makes people or investors believe that there is still more upside to earnings and thereby to asset prices.
Yeah, I think now they're leading. There's a very narrow, concentrated market rally, which actually has been fundamentally kind of supported. So you're absolutely right. Meta and Microsoft, they had good earnings. In general, these tech companies, they're spending, they're doing well on their top line. So they're protecting margins. Their profitability as of now looks fine. In the medium term, we all have to ask questions. If you invest so much, can you maintain your profitability? Can you maintain your return on equity? But for now, they're fine. And the hope is, of course, that as these kind of parts of the market are leading the equity market higher, there's going to be some spillovers because you're easing financial conditions. The S&P 500, if it goes up, is good for the US economy. It's good for the rest of the index. So the hope now is, of course, with this kind of rally in equities, are you getting a bit of spillover to small and mid caps, spillover to other parts of the economy that can kind of be pulled along? And that remains to be seen. We're not that optimistic. And I think one thing that worries us a bit is that a lot of the rally we've seen in equities has been driven by valuations. If you look at earnings revisions, they have been globally and also in the US generally been down into the second quarter. So you've essentially beaten expectations that have come down before. So I think the healthiest equity rally is usually when you have earnings revisions being positive at the same time.
Kristen, how are you viewing the Asian markets per se, and what's your stance with regards to where Indian markets stand?
So you mean in India or in general?
In general, Asian markets as well as India.
So I think generally, like, our view has been focus on diversification. So focus on active kind of opportunities beyond the US. That doesn't mean that we're bearish on the Magnificent Seven, but you got to ask yourself what else is in the US, and are there opportunities outside of the US that might actually be giving you the same kind of business model, the same opportunity to maybe diversify yourself a bit. From valuations that are higher, from profitability that are higher. So small and mid caps arguably are one way to diversify, not just in the US, but globally. We've certainly seen in Europe, small and mid caps do quite well. And the reason for that is that they are more domestic. Like a big problem you've seen is that the weaker dollar has hit a lot of exporters. So you have like a double negative whammy. You have like tariff uncertainty that is hitting global exporters in Europe, and you have the strong euro or the weaker dollar. And as a result of that, small and mid caps in Europe have been a very good way to kind of be a bit more domestic, be a bit less exposed to tariffs and the currency. And I can see that being a bit of a narrative that might be true in other markets as well, where I think the largest companies, they're often the most international, where smaller companies might be more domestic and give you more opportunities that are insulated. So that can make sense to extend the diversification across the regions.
Christian, the data that we have right now shows that FIs have been incessantly on the sell side, at least in India. Maybe they are going for Korea because of the valuations currently, and there is a bit of a load up there, or some other markets. But in India, there has been significant selling, 92 or 93 days of the total number of days traded thus far in 2025 has been net selling. What's your view? I mean, when does global money find its way back into India?
Yeah, I think you're right. Our EM strategy team have also been more neutral on India, because you've had macro headwinds, you've had kind of relatively elevated valuations, you have uncertainty on trade that doesn't help. And I think the way to get international investors to come back to India, in my view, is to refocus on the longer term structural economic fundamentals, which I think are still very favorable, both in the EM context, but also in the global kind of equity market complex. You still have a lot of economic growth potential. And I think the most important thing is to have the cyclical picture stabilize, to kind of make the market focus on the longer term picture again. And I think that really means that the most important thing is positive earnings revisions. As I mentioned earlier, it's most healthy if you generate a positive earnings revision momentum. Our team have been saying that this is something to be expected next year in India. So it could take a bit of time to get international investors to come back to India if it takes that long. But I would certainly argue that the longer term economic story of India, with a lot of the asset allocation in clients that we speak to, is well understood and generally subscribed to. But the shorter term cyclical picture is something they're not comfortable with.
And how does the cycle change, Christian? I mean, does it happen because the global economy has a rising tide carrying all boats along with it? Or does India do something? Because we've seen the Reserve Bank of India come out and really loosen the rates, right, per se. And the government has been kind of putting its head behind trying to do private capex as well as tax cuts leading to consumption. So what changes the picture?
I think you're right. It's not easy for India to decouple from the global economy. So certainly it would help for the global economy to shrug off the trade war and move on towards a kind of more normal state. We do have major fiscal stimulus in Germany, and we have major spending in Europe. We have the big, beautiful bill supporting the fiscal picture in the US. So once we have gone through the negative impacts from tariffs, which are still feeding into economic data in the second half, you would expect a large part of the global economy to start to re-accelerate a bit. And that is something that clearly would help sentiment to be more optimistic on the cyclical picture in emerging markets in India as well. I mean, specifically, as you were saying, the RBI cutting aggressively is helping. I mean, certainly the idea is that if you are kind of in a kind of slowing growth environment, central bank support can mobilize liquidity, can buffer the economy, and can stabilize things. But I think certainly, and this is not just true for India, it's for most economies, it's very tough to decouple from the global picture currently.
Okay. Christian, we'll leave it at that. Thank you so much for taking the time out and being with us. Really appreciate your time.
Thanks for having me.